You know, sorry to get you guys the stuff so late today. I was going to send that out, and then I decided I'm going to make a last minute change, and I didn't realize it was a much bigger change than I thought. But anyway, so today we're starting in chapter 3. At the end of class, if you have any questions on chapter 2, I'll stick around and take any of those. They're due tomorrow. Now, if you don't get it in tomorrow, don't panic. You can always turn it in any time. The only thing is your grade's going to look bad until it gets turned in because tomorrow I start grading them. I usually start, actually, I usually start on Saturday. So you have until midnight to turn it in, but usually Saturday morning I start working on grading them. Yeah, my son, I think I started early. I don't know why I'm talking to myself about this, but anyway, you can always turn them in. So don't worry that, oh, I didn't get it in. You get full grade, but your grade will look bad until you turn it in because it's going to go in as a 0. So just know that even though we have this deadline, it's not really a, it's not a hard deadline, but your grade's going to look bad until you turn it in. Okay, let's see here. So we're going to go ahead and get started on chapter 3, which is the classified balance sheet. And I'm going to pull up. Okay, here. I'm sorry. You go to the first one, the introduction tab, if you in the Excel one. And by the way, I would encourage you to start using the Excel if you're not really familiar with Excel. It's because in accounting you're going to have it all the time. This um, every job I've ever been at, it was had, and it's one of those things that you're going to be doing a lot of. So the more proficient you get at it, quicker you can, the better. And it's in your, if you go to your email, actually, it's also in the email I sent you guys. Go to your email, you come over here at the top, the little, I don't know what you call it, the little chessboard thing, you go to Excel. So everybody has it. It's part of your tuition. Is that okay? It's also it's in Blackboard too. I put it in Blackboard, I think. Is it announcements? It's also an announcement. Can you say, you guys can't see what I'm doing? Idiot. Let's try this again. In your email, you click on the checkerboard over here, whatever it's called. I'm sure it's got a better name than that. And you click on Excel, you can open up Excel. And again, it's part of um, your tuition or whatever is we have Microsoft Office. And it's also though if you go to the announcements for this class, you scroll down and see somewhere here. Here it is. Click on it. Please wait. And you can go to open and open a file, whatever. Open files from this device. Okay. All right, so let's go ahead and get started. That's what I've been saying. I think you guys probably already had this before in your classes, but this is the idea behind it. If I go to a store and I want to buy Cheerios, where do I go? I want Cheerios.
Cereal section.
Cereal section. Notice I didn't tell you what store it was. Because every store, in their cereal section, if you're looking for Cheerios, if they have it, that's where it'd be. So it doesn't matter what store it is. So every store has that. They all have it in, they take things and group together things that are similar. Here's where all the cereal is. Here's where all the soup is. Here's where all the milk or dairy, whatever. They group them in group, and we do the exact same thing on the balance sheet, is to put things that are similar together so that people know where to look for. So if you're looking for, buildings or whatever it is, you know where to look for them. And it's the exact same thing as they do in a grocery store. Take things that are similar, group them together. You don't just have them all over the place where no one knows where they're at. Okay. All right, so we group them. The first groups we do are the assets here. We'll do those first. Current assets. These are things that are up to 1 year. Yeah, right. And these are things that are going to be used or turned into cash within 1 year. I'll put that over here. Common ones would be, you guys are probably familiar. What would be current asset? What would be a common current assets? Have you guys done this in your class? You must have. Anyone? Okay, I'll put them in. Common cash, which is already cash. It's already. Current investments. Receivables. I should say current receivables. Inventory. Prepaids. Prepaid expenses or oops. Am I missing anything? There's probably most of it. There are some little things you might have in here, like supplies or something, which would be similar to the inventory ones, except that you're not selling them, you're using them. Okay, investments. These are for investments that are over 1 year. If anything that is less than 1 year will be in current assets. Anything that's over will be in investments. These are usually called non-current. And you'll see, sometimes you'll see them called, don't. back in my day, they were called long-term. And I think that they kind of got away from that because when you think about long-term, a lot of times you think, okay, that's like 5 years. Well, I mean, it may not be 5 years. Maybe it's 15 months. Anything that's over a year. So when you say long-term, I don't, I think that some people thought that maybe that was, like say, like 5 years, 10 years, something like that. Whereas really it's just more than a year. So they kind of changed that. So a lot of these, when they say current and then they say non-current, you go, well, what that's just the one term, is because I believe anyways, they thought that the saying long term gave the connotation that it was multiple years rather than anything over 1 year. Okay. So investments, and again, these are long-term investments. These could be investments in stock. Those are sometimes called equity investments. Investments in bonds. Debt investments. Unused land. Will be under investment. Hey, wait a minute. Let me do something here. So if you have land that's not being used, it's an investment. Or it could also be land that's being held as an investment. It's probably more. But one of the key features of investments is that are generally there to have a return above whatever you're sinking the money into. Doesn't always work out that way, but you make an investment in stocks or bonds or whatever, they have the connotation that it's going to make some kind of interest or dividend or growth or something like that, that it's going to increase is the hope anyways, when you make these investments. Doesn't always work out that way, but that's the idea that those are revenue generating items that they're working. And even if you're holding something like land for speculation, the idea is that by holding it, you're going to make more money on it when you sell it. Okay, property, plant, and equipment. All these are over 1 year. These are all non-current. Oh, I don't, I'm going to go back to inventory. I know I'm jumping around here. Inventory is always current. The reason I say that is we get this thing that's up to 1 year. That's the usual cycle. But inventory, some people will ask, well, what about wine? You have wine that you have to age for 5 years. That's all considered inventory while it is aging for 5 years. It's considered work in process. It's what you're working on. You're probably not doing anything with it, but you're working on the inventory until it's saleable. So even things like wine and things like that are 5 years, 10 years, whatever they are, those are always considered inventory. So, or excuse me, current assets. So inventory is always going to be current assets, even if it's longer. So, if you're wondering like, well, what about wine? Does that go in long-term investments? It doesn't. Inventory is always going to be in current assets. Okay. Property, plant, equipment is really just what it says. Property, usually land. Plant, usually buildings. Equipment, usually equipment. I'll tell you one that's not so much part of this chapter, but we'll talk about it a little bit. And one are leasehold improvements are usually put here. Second. Camera. Get my Dracula. Okay. Leasehold improvement. Video. Stop sharing. My good man. See my Dracula camera? All right. Let's go to this. Oh. Knocked out. You guys also kind of wavy lines. Camera just tipped over. Okay. So here's what a leasehold improvement is. And the reason I'm talking about this is because for a lot of companies, these are huge dollars. So let's say that you got a lease on a building. For your restaurant. Okay, so here's the building. Let's see here. It's so here's the building. And you've leased it. Here's the land underneath it, which I know is poorly drawn. Okay, so you lease this building and you put your sign out for your business. So this is Joe's Restaurant. This sign is a leasehold improvement. Now, here's why this is a little bit strange that it goes in property, plant, and equipment, and almost all the companies that do this put it in property, plant, and equipment. If you're leasing this building and you attach that sign to it, you don't own it anymore. Whoever owns the building owns the sign. This is an attachment. That's a legal term of it. So you don't actually own the sign anymore. The building does. Now, you put it up there for a reason. You want people to see this sign and come to your restaurant. However, you don't really own it. This is actually an intangible. And oftentimes you'll see that it's one intangible that is not usually put in with intangibles. It's usually put in with property, plant, and equipment because it is similar to property, plant, and equipment, and it's usually attached to something you're leasing. Here's the problem with it. Let's say your lease is for 5 years, and the sign will last for 15 years. Which do you use to amortize that or depreciate it? The 5 years or the 15 years? That's not an H, that's a N. So you got the sign on the building. The lease of the building is for 5 years. The sign will last for 15 years. Which one do you use for the sign to write off the sign? 5 years or 15 years? Anyone? We got our sign here. I'm going to make the sign festive so we get people in. So here's the sign. And it's a good sign. It's going to last for 15 years, but we've at least for 5 years. Over what period of time do we write it off? I gotta turn off this air conditioner. It's freezing. Okay. Anyone? Oh, come on, flip a coin. So the lease is for 5 years. We've attached the sign to the building, which means we don't own it anymore. Whoever owns the building owns the sign. What do we write it off over? How much? How many years? You can put it in chat if you want. If you don't want to say it out loud, you put it in chat and I will. Anyone? Hey, are you guys sleeping already? Yes. Isaiah, absolutely correct. 5 years. Yep. And Amelia, yep, 5 years. That is the absolute correct answer. So this brought up a I got to turn off the Dracula light. This ended up being a very big deal. A few years ago, a lot of these places that thought they were going to have leases for 10, 15 years ended up not having those leases renewed. And there was tons of companies that were really writing off billions of dollars of these leasehold improvements. And they generally keep those in the property, plant, and equipment. So you saw this big chunk of the companies that just disappeared, and you had these huge losses because of it. And if you look around, for instance, like, TGI Fridays or McDonald's or whatever, when they come in, they make the building look like, a TGI Fridays. They make the inside. It's a lot of money to do that, but they do it for a reason. When you walk into a McDonald's, it should look like a McDonald's. But those things that they attach to the building, those are not theirs. And the minute they attach those become part of the building itself. And it's kind of something that it's used because you don't want to have people that leave stuff hanging on buildings that they're not leasing anymore, and the owner can't get rid of them because they don't own it. If they own the building and it's attached, they own it. And if you go to a mall or something like that, you see a McDonald's in a mall. Everything that's in that part of the mall is actually owned by whoever owns the mall. They put it up there for a reason. They want people to come in, but those are at least leasehold improvements. And technically they are intangibles. You put it up for a reason. The reason is to get customers in, but you don't actually own it. It's not a tangible thing that you own anymore. But they are usually put in property, plant, and equipment. And that's one of the kind of exceptions to our normal rule here. These are intangibles, but they put them in with the property, plant, and equipment. And again, they have big problems with them. Intangibles, again, same thing. All these are going to be non-current. All the rest of these assets. Intangibles. They doing no physical value. Now, you can't put your hand on the value.
For instance, the McDonald's name McDonald's, that's an intangible. But you can't put your hand on it. But that just that name McDonald's means something, and it's very valuable. But it doesn't have a physical value. And even things that, and it's a little, let's put a few of these things what they could be. They could be trademarks, trade names, patents, uh, copyrights. I'm sure I'm leaving stuff out. Oh, client lists. If you become a CPA and maybe you want to buy out another CPA firm, let's say you want to start your own CPA firm, but maybe you're working for one and the person that you're working with wants to retire or something like that. If you buy out a small business, oftentimes what you're buying is the client list. A CPA firm, the assets it has, might have a couple computers and a few other things. Those are probably very small, but that client list, the client that you're going to be serving, that is the valuable part. And again, that's intangible. And so a lot of times small businesses, they have a large amount of intangibles because if you buy out another business, you're basically buying the client list. Same thing with like landscaping or something like that. You're buying the client list. The lawnmowers and truck maybe are a few $1,000s or something, but what you're really buying is the client list. That's where you're going to make your money. All right. Probably most of them, but anyway, and if you look at these, you say, okay, well, wait a minute. If you have a patent, I can print out the patent and I can read it and all that. Piece of paper, but the value isn't in the paper, though. The value is in the right to use that process or that idea in a unique way. The paper is not the value of it. So the value is not tangible. Okay. Other non-current assets. And this could be almost anything. Anything that doesn't fit into these other ones are in there. So let me give you some examples of things that could be in there. Just say non-current assets. Non-current assets waiting to be sold. So if you have something, let's say you have a building or a piece of equipment or something like that that you're going to sell, you're not using it. Actually, that brings up an important point that I didn't put in up here. Property, plant, and equipment. These are only for items that are being used. So only for property, plant, and equipment that's being used is in property, plant, and equipment. It has to be being used. If it's not being used, it's not in property, plant, and equipment. And this could be it could be also could be a recently purchased machine that's not being used. So you're going to use it, but you haven't got it installed. You're not using it yet. That would be a non-current, other non-current assets. And you don't depreciate it until you start using it. So recently purchased asset not in use. There's also some pension stuff that runs through here. Yeah. And you could also have long-term, or let's say non-current tax assets. And kind of wacky stuff for the most part. And basically it's a little bit of a collection. It's not uniform. It's kind of like the grab bag, if it doesn't go up here, if it doesn't go in any of these categories, this is the special aisle of the store that has all the other stuff that, you gotta look around for it. Any question on that? But this is a very important part of, and I should have mentioned that right when we were there. Property, plant, and equipment is only for property, plant, and equipment that is in use. If it's not being used, it doesn't go in here. It'll either go down here in non-current assets. It could also go up here in unused land. This is for land that's in use. Up here we have unused land. We're holding it as an investment. So, okay. Question? And same thing for this other stuff too, though. These are all for things that are in use. Or in use, as I like to say. It looks funny. It's true, but it looks funny. Why am I doing this? You guys, I just already told you. You guys already know. Okay. Blah, 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 blah. Liabilities, current liabilities, same as up here. This would be paid or earned. Within 1 year. These are going to be things like current payables. Yeah. Ah, oopsie daisy. Okay. I don't know like that. So current payables. Anything that says, when you see anything that says, um, a few other terms for deferred revenue, which are similar to, they're the same basically as unearned revenues. Customer deposits. What else do we have? Oh, current portion of long-term debt. I should say non-current debt. Okay, current portion of long-term debt is sort of like this. Suppose you have a loan. Yeah. We have a loan and it's going to be paid off in 3 years. Right, so this part of the loan that you're going to pay off within the next year. So let's say you're making installments, like it could be a mortgage or whatever. This part will be current, and these two will be non-current. So the current portion of it, whatever is going to be paid in the next within the next year, will be in current liabilities. So 3-year loan, the next year will be in current liabilities, and then going into the future. And as time goes on, these will go like that. You'll hear some people say that this doesn't change, that you actually take it out of the following years to reduce it because the current liabilities was, that's only if it's a fixed amount, if it's the same amount every year. If it changes the amount, maybe it goes up by 5% or 10%, whatever, then you don't do it that way. But you'll see sometimes, I saw a thing from the Light and Touche that said to do that, but that's only if it says, only if it is the same every year. Okay, non-current liabilities. Non-current payables. Kind of bonds payable. Mortgage payable. Well, the things that are generally long term are going to be in there. Any questions on that? Oh, what am I doing here? Non-current. This is just say non-current. I'm sorry. That's a copy and paste error there of mine. Doggone it. Same thing here. Non-current. Equity is usually over 1 year. It could be infinite. Stocks theoretically don't expire. So these could be Common stock, preferred stock. Additional paid in capital. Which we're not gonna talk about right now, but it's basically, it's a, Slam stock will have a par value or a designated value. And if they pay in addition to that, it's just how much you sell the stock for. All right, retained earnings. Something you'll get into in the future are comprehensive income. Oops. Hey, how come that one's not folded? Which we'll get into. You get into later. Comprehensive income are basically income things that don't show up on the balance sheet, or excuse me, the income statement. These are things that are not on the income statement. And it goes into comprehensive income. It goes right to the equity accounts. All right, that's enough of this stuff. Yeah, man, that's boring. Okay, any questions on this? I don't blame you for sleeping. Okay. This one shouldn't take long. Famous last words, but this one shouldn't take too long. Okay, so here's all our accounts. This is post-closing, so we don't have to worry about an income statement. And so the question is, where do they go? You know what? I realized I pulled this one off, and I should say whether those are in current or long term. Hey, by the way, I'm going to go into the textbook. Is there anyone that still is not getting into the textbook? Or can't get into it? E, 3, 4. Oh, this is short term. Okay. Now we know. Okay, so investment in securities, so I'm gonna put that in there. These are short term, that's their terminology. They usually say non-current, but we will use what they say. Okay, so which things are gonna go into current assets?
Cash, right?
Yep, cash. What else?
Inventory,
One more time?
inventory,
All right, yep. We got three more. Oh, yeah, I gotta put it, oh, I have to put down on some.
Would the accounts receivable
Yep,
be there?
yep.
All right. The prepaid rent too, right?
Yep. And it's investment in equity securities. They use the terminology short term, which, that you'll still see companies that use that terminology, and that's actually what I'm more used to seeing. But that's gonna be in current too. That's yep. Physical. Okay. I think that's it. Because the machinery isn't gonna be there. Okay, so this will be our total current assets. I'm gonna move that over. Yeah, by the way, I don't care what row these rows are just there for, I don't know, laughs, I guess. You can put them all over here if you wanted. I mean, maybe that's what I should have done. Oh, if I do that, then okay, let's try this again. There we go. Okay, so current assets. All right, so machinery will go in. Wait a minute, do we have any investments? I don't think so. I'm going to go ahead and put that in as none, just so we know that we actually looked at it and no, there's nothing in there. Okay, so machinery is going to go in property, plant, and equipment, but there is a catch. What's the catch? The catch is it doesn't fit. Why doesn't it fit? I thought I had these worked out. All right, well, anyway, we have to. Must have goofed that up somehow. Okay, so our machinery is 145,000. However, is it worth 145,000 to us? 100 bucks? No, because we have accumulated depreciation on that machinery. The machinery is really only worth, so it's essentially negative. Oops, two things wrong with that. Wrong amount. I'm gonna do something here. I'm not sure. Oh, these are mixed. That's why. They're mixed sizes. What idiot made this thing? All right. So the net amount of the machinery. You don't have to put this in a separate line. I'm going to do it just to kind of show you what I'm doing here. So usually you just put it as a line, as a line item. Actually, net machinery is probably what you just see on the sheet. So if you're actually looking at this, if they a lot of times they don't put the actual accumulated depreciation. And I think I went into last time why we have that accumulated depreciation. It tells you how far along it is before you have to replace this machinery. How old is it? How much does it cost to replace it? All that kind of stuff. That's why we break it out like this. So it's still showing a mix. Why is that? Come on, everything should be 14. Everything should be aerial. And I think that's it for total. Nothing else there is property, plant, and equipment.
Professor, I had a quick question.
Yeah,
So would that would still be a debit though, right? Because you're minus 134,000 or no?
yeah. This would be a debit. This would be a credit. And these are not debits and credits. These are just columns. And I know that's confusing, but this is the way they usually show it. I can put them all in one line, I guess. So maybe be.
No worries. I was just making sure for like myself that I was understanding it the right way.
Yeah, these are just column one and column two. They're not, I think the book has it, shows it this way is why I did it, and I'm kicking myself. Oops.
Thank you.
No problem. I apologize. There we go. And so this would just be our net, our, let's just say total property plant equipment. That and you can just abbreviate in a test or whatever, you can abbreviate that as PPE, and that's fine. I've actually seen financial statements that just had it abbreviated. Uh-oh. Too long. I'll put it here. You don't really actually, since you only have one thing there, you really don't even need to do this, but. So total property, plant, and equipment, 134,000. Intangibles, we do have an intangible. What's the intangible?
It's the pedant.
Mm-hmm. And you'll see it says here net, and you net of what? I'm gonna go ahead and put that in. Oops. First, I'm gonna mess it up. Then I'm gonna put it in. Net of amortization. We don't depreciate it. It's called amortization. Depreciation is something that happens to tangible assets, whereas amortization is just spreading the cost out. So this lets be net of amortization, and we don't do accumulated amortization. We just take it right off the top. The reason being is that you can't replace these basically. They're unique. And so it isn't like you're going to get any more information on them if we had them separated. But I'm going to go ahead and put that in. And again, just like this one, you probably don't need to total it up. I guess you could, but it's the only thing in there. Other non-current, I don't think we have any. Nope. These are all liabilities, and there's equity. Okay, I think we're done with the assets. Okay, so we can add up the total assets. I'm gonna put in none here just so I know that we looked at it. Oops. All right, and let's see. I'm gonna add up 175 plus 34 plus 83. Okay, current liabilities. We have 3 of them. What are they? Put it in chat. And you can abbreviate them. Accounts payable, AP. Give you that one, we'll put that one in. So things you're going to have to pay off within a year. Accounts payable. What else? Probably, yeah, well, we're probably gonna leave, the bonds will probably be long-term, but we will. But see, things are gonna pay off. Certainly the employees are not gonna wait a year to get paid, so their salaries payable will be probably pretty quickly after the end of the year. And income tax payable. That's most likely gonna be on 3/15 usually, I think is when they have to have that in. We did it in a month earlier than labor system. Okay, so those, I think those are only three. Blah blah blah. Yeah. Okay, so it'll be total current assets. Will be non-current assets. Bonds payable are going to be there. I'm going to copy it and put it in. I'm going to talk a little bit about what bonds payable are. I know you guys probably talked about this in other classes. Um, bonds payable. Bonds payable are they're securities. They're issued, kind of like stock, but they're actually borrowing money. Some small places can do it, but usually larger companies, they have to do bonds payable. A larger company will, to raise cash through, by borrowing, they almost have to do bonds payable. Yeah, that's not me. Because the amounts they're borrowing, a lot of times are so large that no one bank could float them the money. And for instance, there's assembly plants for cars or something like that, maybe it costs 3 or 4 billion to make this assembly plant. To go to a bank and say, hey, can we get a loan for, $3 billion? That's a big amount for any bank. That's a lot of eggs in one basket. So what they'll often do is they'll issue what they call bonds payable. It's like taking that big $4 billion loan that they need and chopping it up into little pieces, and those little pieces are bonds. So maybe these bonds are $10,000 bonds, and you can sell those to anyone. Personal investor can buy those. Banks may buy those. They may very well buy those, and but they're not going to give you the whole 3 billion, but maybe they'll give you 30 million or something, and this bank will give you 42 million, and this bank will give you, excuse me. So it basically is taking a large mortgage, basically, and breaking it up into little bite-sized mortgages that all add up to however much they need. So that's why we have bonds. They are basically just borrowing money, but is chopping that you're borrowing up into smaller pieces so that more people can buy it. And quite honestly, if you needed the whole thing, if you needed all 4 billion, you couldn't get it. Okay. So I'm just gonna leave that. That's our total we have. We don't have any other one. Oh wait, we got one more thing to do here though. Okay, what goes into equity? Well, everything else. These two. All right. Now, if we add all these up, oh, I think I just do like this. Oh, here we go, way down here. Here we go. Hey, look at that, they balance. Yeah. Oh, wait, I can't do it that way. I gotta do something different. This will be the total equity. There are more than one there, so total. And again, but it is kind of what we were talking about before, though, that it's basically I'll zoom in here. It's basically putting all those things that are similar together. So anything, any asset that's less than a year, you look in current assets. Longer term stuff, you look down here. Same thing with liability. Stuff that's going to be due in the next year, you look up here. So, hey, how come I have that there? That's wrong. That's not an asset. That's current liabilities. That's confusing. Okay, so total current liabilities are 44. Yeah, so basically those things that are going to be paid in the next year. So if you're worrying about how much cash do we need for the next year, we have 40,000. We're going to have to be paying off 44,000. It looks like so we got to come up with 4,000 in cash somewhere. Oh, we got accounts receivable of 34,000, so we'll probably get it out of that. Accounts payable, retained earnings. By the way, notice that both of these are actually, included in these assets over here. This isn't, these retained earnings are not just sitting in cash. They are, invested back in the company. Okay, let's go ahead and take a break. We'll say be back at 3:14. Okay, I tell you what, let's go to. We did this one already. Save it. All right, let's go to E5. Okay, E5 is a similar one, but we got a few more hoops to jump through. So I think what we'll do is jump through the hoops first. I think kind of. Okay, so let's take a look at. Oops. So here's all the accounts, and we can figure out where those go. Okay. So let's go to the first one. The $120,000 balance in the land account. Consists of 100,000 for the cost of the land where the plant and office building are located. Okay, so we're using 100,000. The remaining 20,000 represents cost of the land held for speculation. All right, so let's think about this for a second. Well, where is the? I'm gonna actually want to add a row here. The 100,000 for the land is going to go where? The 100,000 for the land is where the plant and, in other words, we're using it. So under which heading is that going to go? We have land that's being used for 100,000.
Property, plant, and equipment.
Yep. Okay, so I'm gonna come down here. I'm just gonna type this in. You don't have to do this, but I'm just gonna kind of make a note here. So let's see, land 100,000. Is for property, plant, and equipment. I'm just gonna label it PP&E. Oops. PP&E. Okay, so 100,000 of it's gonna go on property, plant, and equipment. The remaining 20,000 that were not being used is probably gonna go where? So we have 20,000 of the land is not being used. It's being held for speculation. Which means there
Would it be an investment?
it absolutely would be, yep. So the other 20,000 of land would be in investments. And that is not how you spell land. Okay, so we're gonna break that up. So 120,000 land. So 20,000 is property, plant, and equipment. The other 20,000 is going to be in investments. All right, let's go to the second one here. I don't know. Make it light blue. The $44,000 balance in investments and securities here. Accounts for represents investments in common stock of another corporation. Valley intends to sell one half of the stock within the next year. Okay, so half of it's going to be sold within the next year. And presumably the other half after. Okay, so what are we going to do with that? So 44,000, half of it will be cashed in this year, and the other half will be cashed in the future. And by the way, this is something you get from management. You know, if you're an auditor or whatever, you just ask, you know, they should make a decision. They probably have some some um, documentation as to why they're doing it. We're going to need 22,000 for X, and so that's why we're doing it. But whatever. How are we going to split that one up? I'll give you the easy part. You guys can think about the hard part. The easy part is the 22,000 that we're going to have in the current year. I should do it this way, probably. Current assets. Or so current assets are going to get 22,000 of it. What's going
Would
to
the
get?
other
Go ahead.
would the other 22 go to some kind of equity that you would hold over a year?
Yes, it's going to. It would be. It would be an yep, investments in stock and equity. It is an equity investment. Yep.
Okay.
What am I doing here? Oh, I'm in the wrong one. Hold on. Hey, I'm back. Yeah, so those would be investments. And it would be a equity investment.
I have a question on that. So on the first page on the introduction, why
Mhm.
wouldn't it go under the equity all the way on the bottom? Because that would be over a year and then non-current as well.
Yeah, well, here's the wacky thing about, and this is where the terminology comes in kind of funny. This equity is our owners, our ownership of the people who own us. Um, this equity is when we invest in somebody else. So this, for instance, let's say that we're IBM, we'd have our own shareholders that we have would be over here in our equity. But if we invested in somebody else, like let's say we're IBM and we invest in General Motors, that would be an investment. You know, we're holding their stock, hopefully to make more money on it in the future. So yeah, it is a little bit unfortunate that we have that same, you know, this investment it is an equity. We have equity investments and debt, but it's different than our own. This is our own ones. Let me go to this.
Thank you.
Yeah, no, it's a good, and it is confusing. It is also confusing when I have that there. What's going on? What is that? It's a ghost or something. I got a C sitting there for no reason. Okay. Basically, on this side, everything down to, you know, all the liabilities, these are things that you owe to, these are owed to outsiders. You know, banks, and all that kind of stuff. And this down here is basically what we owe to the owners. Let's just start all over again. And so, yeah, so these are the owners. Now, when you're talking about a different company, though, it's our investing the owner's money in another company's stock, which is a very common thing to have happen. However, it is a little confusing because the owners own basically the investments in the other, in the other stock, but this is what's owed to. And going way back when, if you ran a company, if you were a manager of a company, you were responsible to pay the outsiders and to pay the owners. This side of it was what, if you were a management, that you owed to these people to run the company. And it's a little bit, now we have the owners being more responsible for running the company. But back in the day, this is what you owe to the outsider, this is what you owe to the owners. So this side is what you owed, this other side is what you owned. Everything you owned here, these are all the assets you owned, current, long-term, blah, blah, blah. So this is what was owed, this is what was owned, and they should equal, to this over here. And if they don't, you are responsible for it. It could be anyways. Yeah, so this will be an investment. So any investment in somebody else's stock is going to be either in the current investment, in current assets, or it'll be in the investment part. And yes, it is confusing. They use the same term for both. Okay, let's go to the last one. And this one is let me get kind of orange. The notes payable account, that's way down the page, I think. The notes payable account consists of 100,000 notes due in 6 months and 50,000 notes due in 3 annual installments of 50,000 each. Okay. Well, let's take the easy one. I'm going to break this up. So, because these are actually two different notes. They're not the same note, right? Am I reading that correctly? Notes payable account consists of, and a note, by the way, is something that you sign, and usually there's interest involved in it. Not always, but a lot of times there'll be interest involved in it. And it's different than accounts payable in that it's actually a document. Accounts payable is usually a revolving kind of credit thing, whereas this is actually a document you will sign saying, I owe this amount. And it's sort of like a check in that it doesn't matter if you sign it, it's a valid document. You owe whoever has that money. You say, well, I didn't like the whatever I got with the note pay, whatever. That doesn't matter. If you're signed that note, it means that you are liable for that amount. It's a document that says you owe it, and that's why they have it. I mean, it's so that there isn't any confusion over what you owe to somebody. Okay, so notes payable. I'm gonna break this up. So the 100,000 notes payable, the 6 months, is that going to be current or non-current? The 6 month note. Current or non-current? Any ideas? Is 6 months more than a year?
Yeah, it would be current, right? Because you would have to pay it off within the year.
Yep. This would be a current liability. Okay, so that's the 6 month note. Now this next one is the 3 year note. Looking a little bit more. Yep, it is current. Very good, thank you. Where am I at? And I just did something stupid. Oh, I know, I gotta stop sharing. I don't like sharing anyways. And I gotta change cameras. I didn't mean for this to be like this, but I'm gonna change this. This is a 3-year note. So what they're saying is that we have 50,000 that we're going to be paying off in the next year. You're paid installments of 50,000 each of the 3 years. So this is a $150,000 note. We're going to pay off 50,000 in the current year, and then the year after we'll pay off 50,000, and the year after we'll pay off 50,000. Okay, so of that note, the $150,000 note, yeah, make it pink. Why does that look terrible? Okay, so 50,000 will be in a current liability. And these other ones are going to be in non-current. And this is just a happy coincidence that that turned out like that. Sometimes you just get lucky. That's what it is. Okay, so the 3-year note for 150,000. So 50,000 of it's going to be in the current year. We go next year. This one, these two are going to be in the future. So the total of those two would be 100,000. So these two will be non-current 100,000. Okay, so let's see how that works out here. I gotta go back to, I gotta share again, which I hate doing. Okay, so to the note. Okay, so down here, so 6-month note is $100,000 current liability. That one is fine. This next one, so the 3-year note, uh, 50,000 is current liability. And the other 100,000 is non-current. And let's say non-current. We know it's a liability. Okay, so 3-year note, 50,000 is current liability, and okay, well that's nice and confusing. Let's just jump in and do it. Now instead of filling it over. Okay, so I'll take the easy one. Cash is current 25,000. Okay, investment in equity security. So this is we bought somebody else's shares of stock from somebody else's company. How much is going to go in current?
22,000.
Yep. And the other 22,000 is going to go in investments. I'm just going to go ahead and copy this now. And I know you're saying, hey, how about some confusing shapes to paste in? And yeah, okay. Oh, I forget. I do want to find out who made this. The default color is invisible light blue. Okay. Uh, Accounts receivable has a twist to it. So here's our accounts receivable. Now, we don't think we're going to collect all of those. We're going to have an allowance for uncollectible accounts of 5,000. So what are we going to do with that allowance for uncollectible accounts? What do you think? So we have this 56,000. Some of these are not going to be collected. We estimate that it'll be 5,000. Now we don't know who it is, and if we did, we probably wouldn't sell to them in the first place. But of that 56,000, 5,000 is not going to be collected. So what are we going to do with that 5,000 that's not going to be collected? Is it really an asset? I mean, are we really going to collect 56,000? No, we're gonna subtract that. So this is I'll come all the way over here, 56,000. And we're going to take off this allowance for uncollectible accounts, 5,000. So I'm going to put this in as a negative. Because we were not going to collect 56, and you can put the net allowance, and quite honestly, you'll see on the financial statements, they almost always say net accounts receivable, and that's because they've already done this. And again, we have this allowance account because we don't know who's going to go bad. You know, we know somebody will. Somebody's, people, all kinds of things happen. Their bankruptcy, they leave the country, they die. All kinds of things happen that mean you're not going to collect it. Okay, what else do we have?
Inventory and the prepaid expense.
Yep. Current assets. Oh, that. Okay. We actually have one more investment we got to take care of. So we have the investment in securities. That's fine. Half this year, half next year. Well, actually, don't say sometime in the future.
Would retained earnings go there?
No, it's actually this one we did here. The land.
Oh, the 20,000.
Yeah. So there's 20,000 land. So we're gonna put that in there. And again, that is a wacky one a little bit.
My bad.
No. And truthfully, I mean, it is something that is owned by the owner. That it will definitely be accounted for on the right hand side, either owed to outsiders or owed to the owners. Okay, so this is going to be land, not in use. $2,000. I'll make that yellow so we know where it came from. Dang, that's not yellow. That's yellow. Okay, so let's see here. Okay, so excuse me. So 20,000 is going for land not in use. So the rest of it's going to go in this plain old land. This will be land in use. You really don't need to put that in. If it's in property, plant, and equipment, it's assumed that it's in use. But I am going to do that just so we know, or I know where it came from. Like 100,000. These arrows might make it more confusing. It's funny when I'm doing it, it makes perfect sense or whatever. But then when I look at like if I go back and look over the video or online or something, I go, oh my God. No wonder they want to answer the question. Can't see what they're doing. Okay, so I'm gonna move this arrow a little bit. But we need these. Okay, so building minus accumulated depreciation, so we'll put those both in there. Their plant. $300,000 minus 100,000. Is that right? 300,000 minus, yeah. So the building isn't really worth 300,000. It's worth 200,000. And we do the same thing with the equipment. A lot of times you'll just be showing that. Actually, a lot of times you'll see these all grouped together. PP&E net. You got to go look at the notes to see what's going on. Okay, so equipment was 75,000. And it had depreciated by 25,000. Does copyright go in there?
No, would it be an intangible, right?
Yep, it would be. I'm gonna put that in tangible just so I know, and then I'm gonna add up the property, plant, and equipment. So it'll be total. The property, plant, and equipment, and again, I don't have enough space here. I'll do it. 350,000. What was I doing? I think I was doing those last time. Oh, I didn't add up the investments. Lazy, lazy, lazy. Okay. Okay, so we have, oops, total current assets, total investments, total property, plant, and equipment. I don't think we have any other assets. We do not. I'm not gonna total this one, but we can. It's 12,000 plus 12,000 is 1,000. Okay, so we can add these up and see what percent total assets. So we're gonna do plus 210 plus the 42 plus the 350 plus the 112, 615. I'll find a color for it. Purple. We get purple. Halfway done. And the liabilities are going to be fun. Really on the deferred revenue? I don't think so. So deferred revenue is the same thing as you guys may have talked about it as unearned revenue in your previous classes. It's when someone pays you ahead of time. It could also be customer deposits, but deferred revenue is you've been paid ahead of time. And I think they're moving away from the unearned revenue, the title of unearned revenue to say deferred revenue. It's funny because deferred revenue used to be only for government agencies, but now they're using it for regular companies. Okay, so let's do the easy ones are the accounts payable, the interest payable, and the deferred revenue. I don't see anything for special on any of those. Blah, 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 blah. Nope. Okay, so let's just copy those right over. And then we'll get on with the wacky ones. Oh, you know what? Yeah. Okay, so let's sort out these notes. Okay. The first one is that 6-month note is a current liability. So I'm going to put that in here. So I'm going to say notes payable. I'm going to leave it capitalized so we know that it's a wacky one. And this is the 6-month note. And that one's just by itself, and we're gonna pay it off in 6 months, and that was 100,000. No, I know what I could do. I could hide these. There we go. Okay, so the 6-month note payable is that. Now let's go to that 3-year note payable. Now it's 3 years, but some of that is due this coming year. The first payment is, hey, you can't read it. Did I do something wrong here? Oh, I think that I changed the width of it. The first payment is due August of 2028, which is the next year. Although I don't say that in here. I think this is 2027. I should put a date in here. I'm going to put a date in here now. I think everything in this chapter is 2027. So 2028 would be the next year. All right. So how much of that would be current? Of the note of the 150,000 6-month note. Or no, 3-year note. How much of that would be current?
One year or a third of the value.
Yep. Like an idiot, I covered it. Here, 50,000, yep. Okay, so this will be 50,000. And I'm gonna put on here that this is the current portion. And I'll say current. So the current part of that 3-year note is 50,000. And so the rest of it must be. Is that current hyphenated? I thought that was one word. Apparently I was wrong. Okay, so 3-year payable. Well, I guess I'll put it incorrectly. Non-current is 100,000. So we split up this 3-year note payable between the current portion and the non-current portion. And this is just to tell the reader when they're gonna have to pay this. Okay. I think we can add both these things up. Well, we don't need to add this one up. This one's already total. But total current liabilities. All these, yeah. You could put total on current. I'm gonna. We don't need to do this at all. You know, it's strange. I think I did spell check on this thing. I don't think it kicked out non-current as not being one word, as being hyphenated. Okay. Common stock and retained earnings, where do they go? We already said it. They go on equity. And so this will be total equity. Somebody's gonna say total shareholders equity or total yeah, well, outstanding or whatever. So let's see here. Oh, I know why it's weird looking, but I have all these ones hidden. That's why it looks strange. Okay. All right, so let's see if these add up. Hopefully they do. Hey, hey. Well, that's it. Let's hold on to this. I want to do this one. This will be next week. And by the way, just so you know, a lot of times if you take the CPA exam, what they will ask you, they'll give you all this stuff here, but they might ask you very specifically, for instance, say, what are the total current assets? You know, so you only have to do this section of it, even though they have all this other stuff in there, you only do, you know, this part of it. It's very common to have things like that pop up. And, you know, they want to see if you know, pick up the securities and pick up, you know, this other stuff here. So even though they may not have you do the entire thing, a lot of times they'll have multiple choice questions or something that they'll give you all these. They'll say, what's the total current assets? What are the total current liabilities? You know, they might ask you that. For this. So if you can do those sections, you can do the whole thing. Obviously, you don't have any problem with it. Anyway, you know, sometimes they won't give you the whole thing, but you got to be prepared in case they do, or or that you don't know what they're gonna ask you about. So you say, okay, well, you know, they're gonna ask me about property, plant, and equipment, how much is it? And, you know, they very well could. Okay, let's just stop here. I'm gonna put in stop. So if you haven't already, I know a lot of you have, if you haven't already, make sure you get the exam in, and I'll probably start grading them tomorrow, those of you that turned it in, and get a grade up, because I want you guys to, hey, that's not me. You know, you get that one, you kind of feel like, you know, you'll know what to expect and all that. Any questions on that?
We're gonna pick up the last one next week.
Yeah, we'll do the next one last week. So I just want you guys to make sure you get in the, so this is I'll take a look at the whole thing. Yeah, make sure you get I want you to concentrate on getting the exam in if you haven't already. I think about half of you already got it in, but yeah, so let's work on that, get that, and we'll finish this up next week. We'll E36 is kind of a long one, so we'll this is when it's kind of ironic that we didn't get to it, because this is the one that I was actually, this is why I got it out late. I had to amend it. And I had to amend it because there's a bunch of stuff missing. I thought this was gonna be like, you know, oh, this would be like 10 minutes to amend it to make it into a full financial statement thing, but it was actually much more involved than I had realized. Okay, any questions? Okay, well, I will see you guys next week. Have a good evening.
Thank you, Professor. Have a good one.
See you guys.